A cheerful guide. Friendly, clear, and reassuring, creating a calm atmosphere and making the listener feel confident and comfortable. Clear, articulate, and steady, ensuring each instruction is easily understood while maintaining a natural conversational flow. Emotion, warm and supportive, conveying empathy and care, ensuring the listener feels guided and safe throughout the journey. At 94 years old, Warren Buffett just stunned Wall Street by offloading billions of dollars in positions that advisors are still recommending to retirees. Yet, he isn't following the same playbook as the crowd. If you're near retirement or already there, this perspective could upend your entire approach to your nest egg. Shocking as it sounds, his philosophy didn't simply mature, it took a dramatic turn when he crossed the 60-year mark. Not because he became risk-averse, he realized that the so-called safe bets for those over 60 can be the riskiest moves of all. While most advisors push you into bonds, broad asset allocation, and dividend chasers, Buffett has steered clear of three specific asset classes. One of them is probably lurking in your holdings right now, quietly eating away at your future gains without you even noticing. The first trap: long-dated bonds. That's right, those instruments everyone touts as the bedrock of a conservative portfolio in your golden years. But Buffett has labeled 30-year bonds a terrible proposition for folks in their 60s and beyond. Terrible, not merely risky. And when someone who built a $100 billion empire uses that term, we need to listen closely. In his latest annual letter, he warned that bonds are not the place to be these days, adding that fixed-income investors everywhere, from pension funds to retirees, face a grim outlook. Why is he so dismissive of what most call safety? Because buying a 30-year treasury at 3% is a bet that inflation will stay below 3% for the next 3 decades. Over the last 50 years, inflation has surged past 5% on multiple occasions. Think back to the 70s, when prices rose by more than 6% annually, sometimes reaching double digits. Even as recently as 2022, inflation peaked above 9%. During such stretches, your secure 3% yield turns into a guaranteed drain on your purchasing power each year. Let me give you a real-world example. My neighbor Jim plunked $100,000 into 30-year treasury bonds in 1990 at roughly 8%. Sounds solid, right? But by 2020, that original principal could only buy what $60,000 could purchase back in 1990. Despite never missing a payment, he lost 40% of his buying power. So, what does Buffett do instead? He pours money into companies with genuine pricing power, businesses that can raise their fees without alienating customers. Think of names like Coca-Cola, Apple, American Express, and See's Candies. Picture this. When he first started loading up on Coca-Cola shares in 1988, a can cost about 50 cents. Today, that same can goes for roughly $1.75. Coca-Cola didn't just keep pace with rising prices, it outstripped them. Warren Buffett's stake in Coca-Cola climbed from $1.3 billion to more than $25 billion, turning simple inflation protection into genuine wealth creation. The insight here is straightforward but powerful. Once you're past 60, inflation becomes a far bigger threat than day-to-day market swings. Bonds won't save you. In fact, they slowly undermine your buying power with each interest payment. Let me give you a real-world example. My neighbor Jim plunked $100,000 into 30-year treasury bonds in 1990 at roughly 8%. Sounds solid, right? But by 2020, that original principal could only buy what $60,000 could purchase back in 1990. Despite never missing a payment, he lost 40% of his buying power. So, what does Buffett do instead? He pours money into companies with genuine pricing power, businesses that can raise their fees without alienating customers. Think of names like Coca-Cola, Apple, American Express, and See's Candies. Picture this. When he first started loading up on Coca-Cola shares in 1988, a can cost about 50 cents. Today, that same can goes for roughly $1.75. Coca-Cola didn't just keep pace with rising prices, it outstripped them. Warren Buffett's stake in Coca-Cola climbed from $1.3 billion to more than $25 billion, turning simple inflation protection into genuine wealth creation. The insight here is straightforward but powerful. Once you're past 60, inflation becomes a far bigger threat than day-to-day market swings. Bonds won't save you. In fact, they slowly undermine your buying power with each interest payment. Now, let's talk about Buffett's second avoided investment, broad index funds. You've heard over and over that Standard & Poor's 500 funds are the set-it-and-forget-it solution. Even Buffett himself has said most people should own index funds, famously wagering $1 million that they would outperform hedge funds over 10 years and winning that bet. So why doesn't he use them for his own portfolio? Because there's a big gap between his advice for the average investor and what he actually does, especially after 60. When he recommends index funds, he's speaking to someone with neither the time nor the expertise to research individual companies. Owning a slice of 500 firms makes sense for that person. But Buffett's personal approach has never been that way, not in his 30s, not in his 60s, and certainly not at 94. At his firm, just 5 companies represent roughly 75% of his entire stock holdings, with Apple alone accounting for over 40%. That isn't diversification, it's absolute conviction. And this matters greatly for retirees. In your 30s or 40s, you have decades for average market returns, around 10% per year over the long haul, to compound. But after 60, you don't have decades to wait. Consider that from 2000 to 2009, the Standard & Poor's 500 actually lost money. If you were 60 then and fully invested in index funds, you'd have watched your retirement savings shrink for nearly 10 years. At 65, you can't afford to wait another 10 or 15 years for a market rebound. You need your investments to perform from day one. That's where Buffett's focused strategy shines. Instead of spreading capital across the entire market, he zeroes in on a handful of businesses with nearly unbreakable competitive advantages. Companies that grow earnings year after year, no matter what the broader market does. Take Apple, his largest holding. Since he began buying shares in 2016, Apple has returned more than 400%, compared to about 100% for the Standard & Poor's 500 over the same period. And Apple isn't some speculative startup. One of the most lucrative, cash-loaded businesses ever shows us a vital lesson. Once you hit 60, settling for average becomes a real liability. You can no longer afford to be mediocre. Your capital has to hustle harder and with maximum efficiency. Sometimes that means narrowing your focus onto fewer opportunities, but only if those opportunities are rock solid. That brings us to investment number 3, high-yield dividend stocks. This one might sting because I'm about to question what many approaching retirement treat as gospel. Those so-called dividend aristocrats, companies that have boosted their payouts for 25 straight years or more. If you're like most folks getting ready to retire, you've been told that dividend payers are perfect for your stage of life. Steady cash, predictable income, peace of mind. But Warren Buffett sees it in an entirely different light, and his perspective could transform the way you view income forever. Consider this eye-opener. Berkshire Hathaway, Buffett's firm, now valued at over $700 billion, has not issued a single dividend since 1967. That's more than 55 years without paying shareholders a cent. Yet, if you had invested $10,000 in Berkshire back in 1967, your stake today would exceed $300 million. Why does the world's most successful investor shun dividends? Because he understands the hidden drag of taxes on your compound growth, something most people completely overlook. Every dollar a company hands you in dividends is one less dollar reinvested to expand the business. If you then reinvest that payout yourself, you're still hit with taxes on the income. For example, a 4% dividend taxed at 20% leaves you with just 3.2% to redeploy. But if the company keeps that same 4% in-house and can earn 15% on it, your share count grows tax-deferred until you sell. That's the magic of tax-deferred compounding, and nothing accelerates wealth creation like it. Sure, getting a quarterly deposit feels secure. It's like a financial security blanket. But Buffett realized that collecting income isn't the same as building wealth. In many cases, it actually slows you down. Take Apple. It pays a modest 0.5% dividend, but that's not why Buffett holds it. Over the past 5 years, Apple has repurchased over $400 billion of its own shares. That means his slice of the company's profit pool swells every year, and he doesn't owe taxes on that growth until he decides to sell. Here's the slick advantage of share repurchases versus dividends. When Apple buys back its own stock, Warren Buffett's ownership stake automatically grows. If Apple reduces its outstanding shares by 1%, his remaining shares now represent 1% more of the company. It's essentially a dividend delivered as ownership boost rather than immediately taxable cash. The real trap with chasing dividends is psychological. You see that quarterly check and think, my investments are working for me. In truth, you may be trading away massive compound growth in the name of feeling secure. Buffett's playbook is simple. Let great companies reinvest profits tax-free for as long as possible. Then, when you need income, sell small portions of your appreciated holdings. You'll incur capital gains taxes, typically lower than ordinary income rates, and you'll have far more wealth to tap into. Have you ever fallen into these kinds of traps? Maybe someone told you to pile into bonds for safety or hunt dividend stocks for income. You're far from alone. The finance industry has been steering investors toward these strategies for decades. Now, let's tear down 3 deeply held retirement myths. Bonds are safe havens. They're actually wealth eroders. Index funds after 60 are a golden ticket. They're mediocrity insurance. Dividend stocks guarantee income. They can become tax traps disguised as security blankets. This might feel unsettling because it runs counter to much of what you've heard for years. But here's the thread that connects all 3 pitfalls and explains why Buffett avoids them. They're built on playing not to lose rather than playing to win. And after 60, playing not to lose is a losing game. Conventional advice says get conservative as you age, shift money from stocks into bonds, diversify broadly to avoid any single blow, chase visible dividend payouts, protect what you've built. Buffett discovered something that flipped this on its head. After 60, your biggest risk isn't a short-term market dip, it's outliving your money over the long haul. Retirement isn't a finish line where you lock down your nest egg and live off it. It's the start of a new financial phase that can last 30 years or more. In 3 decades, even modest inflation can slice your purchasing power in half. Markets will crash and rebound repeatedly. Entire industries will rise and fall. So ask yourself, do you want to spend those 30 years watching safe assets slowly lose value? Or do you want your wealth to keep growing alongside the world's most profitable companies? Buffett chose growth. At 94, over 90% of his portfolio remains in stocks. He's not living on bond interest or dividend checks, he's betting on the future profitability of American business. It has propelled him into the ranks of the wealthiest individuals ever. The brilliance of Warren Buffett's strategy lies in its disciplined precision. He refuses to gamble or scatter his capital across 500 average businesses. Instead, he zeroes in on 10 or 15 top-tier firms. He shuns bonds that guarantee losses to inflation and purchases companies capable of raising their prices. And rather than drawing dividends he doesn't need and paying taxes on them, he lets his money compound tax-free inside outstanding businesses. This shift in mindset is not about chasing higher risk, it's about getting smarter. It means understanding that the rules that built your nest egg up to age 60 won't carry you safely through the decades ahead. It takes courage to break away from the herd and abandon an outdated playbook. If you're wondering, okay, bond funds and dividend stocks aren't the solution, what should I be doing? Here is Buffett's actual late career playbook, distilled into 3 principles you can apply right now. And the best part is that it isn't complicated. Some of the greatest tactics are the simplest. First principle, trade bonds for businesses with pricing power. Instead of lending money to the government at rates that erode purchasing power, become a part owner of companies that can raise prices faster than inflation. Buffett calls this pricing power, and it's arguably the closest thing to a financial superpower. When a leading coffee chain hikes a latte from $4 to $4.50, people don't stop drinking coffee. When a top smartphone maker raises its flagship device from $999 to $1,099, buyers still line up. When your local utility company boosts rates by 10%, you don't turn off the lights. These firms command pricing power because they offer goods or services people need, want, or cannot easily replace. Owning shares in those businesses turns inflation into an ally. Price increases drive profits higher, and your equity grows more valuable. Look for sectors like essential utilities, dominant technology platforms, patent-protected healthcare, consumer brands with wide moats, and energy companies controlling scarce resources. Your goal is businesses with indispensable or uniquely desirable offerings. Second principle, concentrate on quality, not quantity. We've been taught that broader diversification equals greater safety, but Buffett's portfolio tells a different story. Approximately 75% of his assets sit in just 5 companies. That's not a coincidence, it's intentional. After age 60, you don't need a sliver of every public company. You need meaningful stakes in a handful of the very best. Seek enterprises with unassailable competitive advantages, management teams that allocate capital brilliantly, and a history of steady earnings growth across all market conditions. Consider this. Would you rather own 1% of 100 mediocre restaurants or 10% of the 5 best eateries in your city? A focused portfolio maximizes your upside when things go well and gives you real control over your financial destiny. I'm not suggesting you risk everything on a single stock. That's speculation, not investing. But holding 10 to 15 carefully chosen companies is a world apart from owning 500 random names through an index fund. By concentrating on around 10 to 15 companies, you really understand exactly what you own. You can dive into each company's business model, monitor its performance, and make clear-cut choices about when to hold on and when to exit. The third guiding rule is to focus on total return rather than immediate income. That's where Buffett's mastery of tax strategy shines. Instead of collecting dividends taxed as ordinary income, he leaves his gains inside his businesses to compound. No current tax drag, maximum growth, and full control over when and how he turns those gains into spendable cash. Here's how it works in practice. Suppose you need $50,000 a year to supplement your retirement. Rather than buying dividend-paying stocks that send you $50,000 annually and trigger taxes on that full amount, you invest in shares that appreciate and then sell $50,000 worth when you need it. Dividend income is taxed at ordinary rates, possibly at 22%, 24%, or even higher, depending on your bracket. But capital gains from selling appreciated stock are taxed at capital gains rates, capped at 20% for top earners and potentially 0% if your overall income is modest. Plus, you're taxed only on the profit, not the entire sale. If you sell $50,000 of stock originally acquired for $30,000, you pay tax only on the $20,000 gain, whereas dividends get taxed on the full $50,000. There's an even bigger advantage. With appreciating equities, you're not forced to sell in a down market. You can live off cash reserves or other income and let your investments recover on their own. Try doing that when dividend stocks slash payouts during downturns. Buffett's post-60 strategy isn't about being overly cautious or wildly aggressive. It's about being strategic. Own businesses, not bonds. Be selective, not scattered. Let your wealth grow before you touch it. And remember, at 94, Warren Buffett is still playing the long game. Are you ready to adopt the same mindset?